Okay, let's unpack this. Where does money really come from? You know, the stuff in your bank account, the cash in your wallet,
Hmm.
it feels like it's just, well, there. Something you earn, you save, you spend.
Right, it seems pretty straightforward on the surface.
But when you actually dive into the sources you've gathered, academic papers, central bank explainers from, like the Bank of England, the Fed, it gets way more complex. And honestly, absolutely
It's,
fascinating.
it's definitely a journey. We're going beyond those simplified models you often hear about.
Mm.
This stack of material, it includes insights from economists like Steve Keen, Perry Merling.
Hmm.
They really take us deep into let's say, the actual plumbing of the financial system.
Exactly, the plumbing. Not just theory, but the real nuts and bolts. So, our mission today is to take these sources and really pull out the most important insights.
Yeah, try to piece together the big picture.
We want to understand the fundamentals, right? How money and credit get created, the roles banks and central banks play, and how this whole system behaves, when things are ticking along nicely, but also, crucially, when things go wrong, like in a crisis.
And uncover some surprising facts along the way. See how these different pieces connect.
Yeah.
Get past the common assumptions.
Right. See how it really operates according to these deep
I'll
dives.
do it.
So let's jump right in. The basics. How is money created? Because these sources, they present a view that's, well, pretty different from what many of us learned. There's that traditional idea, isn't there?
There is, yeah. It's usually called the loanable funds model.
Loanable funds.
And in that view, banks are mostly just intermediaries. They gather up existing savings money that people like you deposit, and then they lend that specific money out to borrowers.
So the bank is like a conduit, just
Yeah.
moving money from savers to borrowers,
Not
pre-existing money.
exactly, like a channel, point A to point B.
Yeah. Okay, but the sources we're looking at, they're pretty blunt about that model. One source, I think it was Steve Keen's work, calls it structurally incorrect. Pretty strong words.
It is strong language, yeah. And that's because the core idea pushed in several of these sources and, interestingly, backed up by some big central banks after the 2008 crisis, is this concept of endogenous money,
Endogenous money.
or, as Keene puts it, BOMD, bank-originated money and debt.
Bank originated money and debt. So banks aren't just passing money along then.
No, that's the absolute fundamental difference.
Mm.
In this view, banks are loan originators. They don't need to wait for someone to deposit money before they can make a loan.
Wait, really? They don't need the deposits first?
Not directly, no.
Okay.
When a commercial bank decides to make a loan, say you get approved for a mortgage,
Huh.
the bank does two things on its books simultaneously.
Okay.
It marks up its assets, that's the loan itself, you promise to pay them back. And at the same exact moment, it marks up its liabilities by creating a brand new deposit in your account for the loan amount.
Hold on. So the money that appears in my account for that mortgage, it wasn't sitting in the bank's vault beforehand. The bank literally created that deposit when it gave me the loan.
Precisely. That's the core insight. It's new money. Specifically, it's credit-based deposit money brought into existence by the act of lending. It's not just shuffling existing funds around. It's actually expanding the total amount of deposit money in the economy.
Wow. Okay, that is counterintuitive because you always think the deposit has to come from somewhere first, right? Like my salary getting paid in.
We tend to think from our own experience, yeah. But from the bank's perspective, the loan creates the deposit.
And what's really striking is you said central banks are acknowledging this now. This isn't just some fringe theory anymore.
Not at all. The Bank of England published a really clear paper, Money Creation in the Modern Economy, that explicitly lays this out. And they specifically reject both the loanable funds and that old money multiplier model. The German Bundesbank has said similar things. It's become, well, much closer to the official understanding.
Okay, so if banks create money when they lend, what stops them? Why don't they just create endless amounts of money in loans? What's the constraint?
Well, it's not unlimited. It's heavily constrained by the bank's confidence. Their confidence that the loans they make will actually be repaid.
Makes sense. Risk.
Exactly. The absolute key factor influencing how much they lend is their perception of credit default risk, the risk that the borrower just won't pay them back.
So it depends on how risky they think the borrower is, and maybe the loan itself.
Yes, and the sources give a really good example of this. Property lending. Think about a time when house prices are going up steadily, maybe even rapidly.
Which feels like most of the time in recent memory in many places.
Right. When that's happening, banks look at mortgages and property development loans, and they perceive the credit default risk as being lower. Why? Because the property itself acts as collateral.
Okay, security for the loan.
If the borrower defaults, The bank can take possession of the property and sell it to get their money back. And crucially, if property prices are rising, the value of that collateral is likely higher than the loan amount, giving the bank a buffer.
And the borrower is probably less likely to default if their house is worth more than their mortgage, right?
That too. They have equity, they have an incentive to keep paying. So rising property prices make banks feel much safer about lending for property,
It lowers their perceived risk.
dramatically in some cases.
Hmm.
So they tend to increase their lending for property purchases. It creates this pro-cyclical effect. And conversely, the sources point out, if property prices were to fall significantly,
Then the perceived risk shoots up.
exactly, default would likely rise, the collateral value shrinks, banks have to provision for losses, and they become much, much more cautious about making new property loans. It's a really powerful feedback loop tied directly to asset prices and risk perception.
Okay, so commercial banks create deposit money through lending, driven by confidence and risk assessment, especially links to asset values like property. But you mentioned governments too. How do they create money, according to these sources? How does that fit in?
Yeah, that's the other major piece of the puzzle here, another layer of money creation. The sources describe this as how fiat money, government-issued money, not backed by, say, gold, is created.
Fiat money, right.
And interestingly, they frame a government budget deficit when the government spends more than it collects in taxes, not necessarily as a bug or a problem, but potentially as a feature of how this type of money enters the economy.
A deficit as a feature. That's definitely not how it's usually talked about.
It's a different perspective for sure. The sources explain it using balance sheets again, similar to the banks. When a private bank makes a loan, it expands both sides of its balance sheet. Assets and liabilities grow together.
Right, the loan and the deposit.
The government, when it spends money into the economy, say, paying salaries, building roads, funding programs, without fully covering that spending by taxing or borrowing that same amount back from the non-government sector, it effectively adds net financial assets to the rest of the economy.
So the government spends maybe by crediting bank accounts, and if it doesn't tax that exact amount back or borrow it from us, that money just stays out there as new financial wealth for someone.
That's the essence. Think of it like the government spending money into existence. The sources connect this to a kind of accounting identity, sometimes called the conservation law in finance. It basically says that the sum of all financial equity or net financial wealth across all sectors of the economy has to be zero.
Zero sum.
In an accounting sense, yes. So if the government sector runs a deficit, its financial equity goes negative on paper. By accounting identity, this must create an equal amount of positive financial equity, or net financial assets, for the non-government sector's combined households, businesses, maybe the foreign sector.
Ah, okay. So the government's negative equity from deficit spending creates the positive equity or net financial assets for everyone else. That's the source of new fiat money.
That's how these sources frame the creation of net new financial assets from the top down, yes.
So we've got two main ways money gets created then. Private banks creating credit money bottom up through lending,
Driven by loan demand and risk perception.
and the government creating fiat money top down through deficit spending that isn't financed by borrowing from the non-government sector.
Exactly. It's not just one simple mechanism. It's a multi-layered system.
Hmm.
And that complexity leads us very nicely into another really powerful concept from these sources, especially from Perry Merling's work.
Okay, what's that?
It's the idea of viewing the entire financial system as a hierarchy of money and credit.
A hierarchy, like levels, different kinds of money being more fundamental than others?
Precisely. He describes a simple version. At the very top, historically, you might have gold, the ultimate, universally accepted money. Below gold, you have currency, the notes and coins issued by the central bank. Below currency, you have deposits in commercial banks. And below deposits, you have securities, things like bonds, IOUs, other financial promises.
Okay, so gold, then currency, then deposits, then securities. Like a pyramid. What's the key insight here?
The key insight is that what functions as money at one level of this pyramid often looks like credit, a promise to pay from the perspective of the level above it.
Sure. How does that work?
Think about national currencies, like the dollar or the pound. Historically, even when they were on the gold standard, they were essentially credit instruments. They were promises by the central bank or government to pay a fixed amount of gold on demand.
Right, an IOU for gold.
Even though they were backed by gold reserves, the note itself was still a promise. So currency is credit from the viewpoint of gold. Now, what about bank deposits?
Okay, well, a deposit is the bank promising to give me currency if I ask for it, right? At the ATM or the counter.
Exactly. So a bank deposit is credit from the perspective of currency or central bank reserves. It's the bank's promise to pay the higher form of money. But for most of us, most of the time, those bank deposits are our money. That's what we use for payments.
Yeah, I tap my card, the deposit balance goes down, it functions as money for me.
And that's why standard measures of the money supply, like M1 or M2 that economists track, are mostly made up of currency and various types of bank deposits.
Okay, makes sense. And securities, like a corporate bond, that's credit from the perspective of deposits or currency.
Yes. A bond is just a promise by the issuer to pay you, the holder, specific amounts of money, meaning currency or deposits on specific dates in the future. It's an IOU.
So it's promises all the way down.
Almost. And here's the mind-bending part highlighted in the sources. Except for that ultimate base money at the top, historically gold, now perhaps central bank reserves for the banking system, all these other instruments, currency, deposits, securities, appear as both assets and liabilities somewhere in the financial system.
Both an asset and a liability. How?
Think about balance sheets. Your bank deposit is your asset, but it's the bank's liability it's promised to pay you.
Okay, right.
A government bond is an asset for whoever holds it, but it's a liability for the government. A mortgage is an asset for the bank, a liability for the homeowner, you see.
Yeah, every credit instrument is someone's promise, so it's their liability, and someone else holds that promise, so it's their asset.
Exactly. And the sources argue if you could theoretically combine all the balance sheets in the entire economy, government, central bank, all the banks, all the businesses, all the households, all these forms of credit, these promises, would appear on both sides of the combined ledger. Your asset is someone else's liability. They'd cancel each other out.
So all the IOUs net out to zero across the whole system.
That's the idea. The only thing that might be left in a historical gold-based system is the gold itself, because it's an asset that isn't simultaneously someone else's liability or promise to pay. It sits outside that web of credit.
Wow. So almost everything we think of and use as money today is actually just a form of credit, a promise circulating within this layered hierarchy.
That's the fundamental reframing offered by this money view. It's a system built on layers of promises, where each layer is ultimately supposed to be convertible into the layer above it. And this hierarchy, this pyramid, isn't static. It's constantly shifting and changing.
How so? What are the dynamics?
The sources point to two main types of fluctuation. First, and maybe most obviously, the quantity of credit expands and contracts at each level.
Like booms and busts.
Exactly. During economic expansions, confidence is high, banks lend more freely, credit expands down the pyramid, often reaching borrowers who might be considered riskier, what the sources sometimes call marginal borrowers.
Okay, money flows easily.
Then, in a downturn or a crisis, confidence evaporates. Credit contracts sharply. Lenders pull back. Those marginal borrowers find it hard or impossible to repay or refinance. Only the safest borrowers, the prime ones, can still access credit easily. The quantity shrinks.
We definitely see that happen. What's the second dynamic?
The second one is subtler, but maybe even more important for understanding crises. The perceived quality or moneyness of different credit instruments changes.
Moneyness. How much like real money something feels.
Sort of, yeah. In good times, when confidence is high, the liabilities of borrowers at one level, say a highly rated corporate bond or certain types of commercial paper, are treated by market participants as very close substitutes for the liabilities of the level above them, like bank deposits or even central bank money.
People trust them almost as much. They're almost interchangeable.
Pretty much. The perceived differences in risk shrink. There's less need for sharp differentiation. They possess a high degree of moneyness. But in a contraction or crisis,
That changes fast.
very fast, suddenly everyone becomes acutely aware of whose promise they are holding. Differentiation returns with a vengeance. Lower-level credit instruments lose their moneyness. They're no longer seen as safe or easily convertible into higher-level money. People flee to quality, wanting only the safest, highest-level assets.
That sounds exactly like the panic in a financial crisis. Everyone wants cash or treasuries.
It's a defining feature, absolutely. And we'll definitely dig into the 2008 crisis using this exact lens later. But first, Merling points out this fundamental tension driving the hierarchy's dynamics. It's scarcity from above, elasticity from below.
Scarcity from above, elasticity from below. Explain that.
Okay, the scarcity part means that people or institutions operating at any given level cannot create the money of the level above them just by wanting to.
Right. I can't just print Bank of England notes in my basement.
Exactly. And a commercial bank can't just create central bank reserves out of thin air. It has to borrow them or attract deposits that bring reserves with them. Even the central bank, back in the gold standard days, couldn't just create more gold. The availability of that higher level money acts as a discipline, a constraint on the layers below.
Because ultimately, the promises might need to be settled in that higher level money.
Precisely. Credit is payable in money, but money from the level above is scarce for those operating below. That's the discipline from above.
Okay, so what's the elasticity from below?
The elasticity comes from the fact that people or institutions can create credit at their own level, or effectively create money for the levels below them through their own actions.
Like the banks creating deposits when they lend.
That's the prime example. Banks create deposits, which are money for you and me, by making loans. Or even simpler, the sources mention, if you and I agree to trade using an IOU, I give you goods, you give me an IOU, promising to pay me later. We've just expanded credit at our level. We created a financial instrument between ourselves.
We created our own little bit of elasticity.
Exactly. This ability to create credit within a level and for the levels below provides flexibility. It allows the economy to function and expand without being rigidly constrained by the absolute quantity of the ultimate base money at the very top.
Yeah.
It gives the system degrees of freedom.
So it's this constant interplay. The system trying to expand credit from below, creating elasticity, bumping up against the scarcity of the higher level money that provides discipline.
That's the dynamic tension at the heart of the system described in these sources. And understanding this tension helps us see why that traditional money multiplier model we mentioned earlier,
Yeah.
well, why these sources argue it's a fundamentally flawed way to think about how things work today.
Yes, the money multiplier. That's the one you learn in Econ 101, right?
Yeah.
Where the central bank injects, say, $100 of reserves into the banking system.
Mm-hmm.
And because banks only have to hold a fraction of deposits as reserves, the reserve requirement, they lend out the rest. That loan gets deposited somewhere else, that bank lends out most of that, and so on, leading to a total increase in the money supply that's a multiple of the initial $100.
That's the textbook story, yeah.
Yeah.
The central bank controls the base money, H, physical cash, plus bank reserves at the central bank. The total money supply, M, is deposits plus cash held by the public. The multiplier links the two.
Yeah.
M equals milli-MH.
And the size of that multiplier depends on how much reserves banks choose to hold or are required to hold relative to deposits, and how much cash the public wants to hold relative to deposits.
Right. In that model, the central bank controls H through things like buying bonds, open market operations, and then the banking system and the public determine M, and voila, you get the money supply. A small change in H is supposed to cause a predictable larger change in M.
Okay, sounds logical on paper, but the sources we're diving into, they really push back hard against this.
They really do, particularly writers like Keene, Mitchell, and even the central bank papers themselves. The core argument is that, in practice, central banks in places like the US, UK, Canada, Australia today do not control the broad money supply by tightly controlling the quantity of base money.
So what do they control?
They primarily target the price of base money. The interest rate banks charge each other for overnight loans of reserves. In the U.S., that's the federal funds rate. They supply whatever quantity of reserves is needed by the banking system as a whole to keep that rate at their target level.
So banks don't wait for reserves to show up before they decide to lend.
Not according to the endogenous money view. Banks make lending decisions based on finding creditworthy borrowers and profitable opportunities, considering the interest rate they'll have to pay for funding. Then they worry about getting the reserves they need to meet regulatory requirements or settle payments with other banks.
And the central bank just provides those reserves on demand at the target interest rate.
Broadly speaking, yes. The system works so that reserves are available. Reserves aren't some scarce commodity that limits lending in advance. Loans create deposits first. Reserves follow later as needed to support the system and the interest rate target.
And you mentioned reserve requirements aren't really the constraint they used to be.
Right. For many banking systems, required reserve ratios were lowered dramatically or even eliminated entirely, like in the U.S. recently. Banks hold reserves primarily for payment settlement purposes, not because of a binding fractional requirement limiting their lending multiple. The central bank can create reserves essentially at will, electronically, so they aren't physically scarce in the way the multiplier model implies.
So the whole money multiplier story, while maybe a useful simplification once, just doesn't capture the causal links in the modern system. Loans drive deposits, drive reserves, not the other way around.
That's the strong critique coming from these sources. And to really understand how central banking does operate and how this hierarchy and elasticity play out in practice, we need to shift to what Merlin calls the money view perspective.
The money view.
Yeah, it's a way of looking at finance that really focuses on the plumbing behind the walls, as he puts it, the actual mechanics of how payments get made, how cash flows are managed day to day, how financial institutions meet their obligations.
Less about abstract equilibrium, more about the nitty-gritty flows.
Exactly. It contrasts with, say, traditional economics that might focus on real capital and long-run growth, or traditional finance focusing on asset pricing based on future cash flows, often abstracting away from the messy details of how those cash flows are settled moment by moment.
It's about the practical reality of the payment system.
Precisely. And to illustrate this, Merlin often takes us back to Walter Bagehot's descriptions of the 19th century London money market in his book Lombard Street.
Bagehot, right. Famous name in central banking.
The key instrument back then wasn't repo, but the bill of exchange. Basically, a short-term IOU used to finance trade. A merchant selling goods might get paid with a bill promising payment in, say, 90 days. They could then sell that bill to a bank immediately at a discount to get cash sooner.
Okay, so banks bought these trade IOUs.
Yes, they discounted them. And banks managed their own daily cash needs by managing their portfolio of these bills, timing the cash inflows from bills maturing versus the outflows needed to discount new bills. If a bank needed more cash, it could slow down its discounting of new bills or sell some bills it already held.
And they adjusted the price they paid for the bills.
Exactly. They adjusted their discount rate. A higher rate would discourage merchants from bringing in new bills. A lower rate would attract more business. The market interest rate essentially moved with the supply and demand for cash and bills.
And where did the Bank of England fit in?
It was the bank for banks, the central repository of the nation's ultimate cash reserves, which was gold or Bank of England notes convertible into gold. Other banks kept accounts there. If a bank was short on cash, it could go to the Bank of England and re-discount some of the bills it held or borrow against them to get reserves.
So the Bank of England was the ultimate source of liquidity for the system.
It was. And crises, from this money view perspective, looked like a sudden, massive, system-wide demand for cash. Everyone scrambling for reserves at the same time, putting immense pressure on the Bank of England. This is the context for Bagehot's famous principle for how a central bank should act in a crisis.
Which is?
Lend freely, but at a penalty rate against good collateral.
Okay, break that down. Lend freely.
That meant the bank shouldn't hold back. It should provide all the liquidity, all the cash, needed to meet the internal demand, the panic within the country. Don't worry about normal rules. Even suspend legal requirements for gold backing of notes if necessary to satisfy the domestic need for payment. Mobilize the reserves.
Okay, stop the internal panic by providing the cash. What about at a penalty rate?
The interest rate charged for this emergency lending should be high, higher than the normal market rate. This was crucial. It discouraged banks from relying on the Bank of England unless they really needed to, and it incentivized them to pay back the loans quickly once the panic subsided. It imposed a cost for accessing the lender of last resort.
So provide liquidity, but make it expensive. And against good collateral.
This meant the bank should only lend against assets that would be considered sound and valuable in normal times. Don't lend against garbage assets just because it's a crisis. The goal is to provide liquidity to solvent institutions facing temporary panic, not to bail out institutions that are fundamentally broke.
Got it. Lend freely, high rate, good collateral. Seems like practical wisdom.
Hard-won practical wisdom, yeah. Now, Bagehot's big constraint was the external drain. The bank could create sterling notes or deposits to meet domestic demand, but it couldn't create gold. If foreigners started demanding gold in exchange for their sterling, the bank faced a hard limit. Suspending gold convertibility was the ultimate crisis measure for that external pressure.
So Bagehot's world was about managing liquidity under a gold standard. How did things evolve from that to the modern U.S. system we have today?
Several huge shifts happened over the 20th century. First, obviously, the link to gold was progressively weakened and then completely severed in the early 1970s. The U.S. moved from a gold dollar standard to just a plain dollar standard.
The dollar became the ultimate reserve, not gold.
Effectively, yes, for the global system. Second, the main instrument used in the core money market shifted. Instead of trade bills, the repurchase agreement, or repo, became dominant, especially repo using government securities as collateral.
Repo lending money short-term against securities.
Exactly. It's the cornerstone of modern money markets. Third, government debt itself became absolutely central to the financial system, largely due to financing World War I and II. The Federal Reserve ended up playing a key role in stabilizing the market for government bonds, ensuring they were always liquid, essentially guaranteeing their convertibility into cash through the actions of security dealers it supported.
So the Fed's relationship with the government bond market became crucial. And the Fed itself was created much later than the Bank of England, right? 1913.
Yes, the Federal Reserve Act of 1913 was a response to recurring financial panics and instability in the U.S. system, which lacked a central liquidity provider like the Bank of England. The framers had this idea, influenced by the bill market, that the Fed should provide liquidity primarily by rediscounting productive commercial loans, short-term loans, funding real business activity, which were supposed to be self-liquidating. They wanted to distinguish this from speculative loans used for trading assets.
Trying to channel credit towards good uses. Did that work?
Not really, according to the sources. The distinction proved problematic. And more fundamentally, American banks had always relied less on loans self-liquidating and more on what Harold Moulton called shiftability.
Stability.
The ability to sell assets quickly in the market to get cash when needed. Even before the Fed existed, U.S. banks often got liquidity by selling bonds or other securities to dealers, who were often funded by speculative call loans. The Fed Act technically made commercial loans shiftable to the Fed via the discount window, but banks largely continued their old practices of ensuring liquidity by holding assets they could shift in the market. Liquidity in the U.S. system became, as one source puts it, tantamount to shiftability.
So liquidity wasn't about waiting for loans to mature. It was about having assets you could sell fast.
That became the dominant reality. And this dealer-based market liquidity was central. In the 1920s, the New York Fed, under Benjamin Strong, pioneered using open market operations, buying and selling Treasury securities, to manage overall reserve conditions and influence interest rates. This was seen as adapting British discount rate policy to the American context.
Using the bond market instead of the bill market.
Right. It aimed to stabilize interest rates and prevent the sharp seasonal swings the U.S. used to experience. But the sources note, this policy of keeping money market conditions relatively easy is also seen as having fueled the speculative stock market bubble that burst in 1929. Providing ample liquidity can have unintended consequences.
So even early on, Fed actions aimed at stability had complex effects on asset markets.
Definitely. Fast forward past WWII, the Fed had been pegging government bond prices to help finance the war. In 1951, the Fed Treasury Accord freed the Fed from that obligation. Under Chairman William McChesney Martin, the Fed adopted the bills-only policy.
Bills only, meaning?
Meaning the Fed would conduct its open market operations primarily in short-term Treasury bills, leaving the market for longer-term Treasury bonds largely to private dealers. The idea was explicitly to rebuild and foster the private dealer infrastructure, reinforcing that model of liquidity based on market shiftability, not just Fed discounting.
So the Fed was actively shaping the market structure again, pushing towards this dealer-centric model.
That's a key takeaway from the money view. The central bank doesn't just set a rate in a vacuum. It operates within and actively shapes the market structure, particularly the dealer network.
Okay, so this brings us closer to the modern system. How does the Fed operate today, and what's the role of these dealers now?
Well, the main interbank market is the federal funds market, where banks lend reserves held at the Fed to each other overnight. The Fed targets the interest rate in this market. It controls the supply of these reserves primarily through operations in the repo market, especially Treasury repo, to influence where the federal funds rate actually trades.
So repo is key for the Fed's implementation too, not just for dealers.
Absolutely. But the sources point out there's slippage. The Fed has tight control over the federal funds rate, but that doesn't always translate perfectly to broader funding conditions in markets like the general collateral repo market or the huge offshore eurodollar market. The Fed is actually a relatively small player in the vast overall repo market.
Its direct control is narrower than the whole funding universe.
Right. And the traditional discount window, Bagehot's main tool, Its direct use has declined significantly compared to his day, though its existence provides a backstop.
So where does market liquidity, that shiftability, come from today?
For major capital market assets, think treasuries, corporate bonds, mortgage-backed securities liquidity, often originates in the treasury market, the most liquid market, and then spreads outwards through arbitrage carried out by dealers. Dealers are the crucial link.
How do they link things?
They bridge funding liquidity, their ability to borrow cash cheaply in the money market, mostly via repo. With market liquidity, their willingness to stand ready to buy and sell securities in the capital markets, quoting bid and ask prices. They make markets, providing shiftability for everyone else.
They use the money market to finance their market making in the capital market.
Precisely. A simplified dealer balance sheet might show them holding an inventory of longer-term bonds, their assets, financed by very short-term repo borrowing, their liabilities. They make money from the bid-ask spread, and potentially from the yield difference, but they're exposed to risks if funding dries up or asset prices fall.
And how does the Fed influence them?
By stabilizing their funding costs in the core money markets, like Fed funds and Treasury repo, the Fed essentially weakens the survival constraint for these dealers. It makes them more willing to hold inventories and take risks, influencing their position taking and thus asset prices across the board.
So monetary policy like the Fed changing its target rate or buying selling securities hits the dealers almost instantly?
That's the money view argument. It works immediately by affecting dealers' balance sheets, their willingness to provide liquidity, and therefore pushing asset prices around. The effect on, say, Main Street bank lending to businesses is more indirect, filtered through these market effects, and happens with a lag.
That's a very different transmission mechanism than the old money multiplier idea. It's all about dealers and asset prices first.
Completely different emphasis. And the 2008 crisis, according to these sources, is the ultimate terrifying illustration of what happens when this dealer-centric system breaks down catastrophically.
Okay, let's use 2008 as a case study through this money view lens. What happened?
The setup was a sudden, massive shift in preferences. People, investors, institutions, they desperately wanted money, the safest kind, and wanted to get rid of riskier securities. A flight to safety, but on an epic scale.
Away from things like mortgage-backed securities towards treasuries and cash?
Exactly. Now, the sources say in a normal, milder crisis, the system might absorb this. Dealers would step in and buy the securities being sold off, financing them with bank loans. Banks would expand their loans to dealers, funding those by accepting the deposits from the public who were selling the securities. Balance sheets would adjust, accommodate the shift.
The shock gets absorbed by the intermediaries.
Right. But 2008 wasn't mild. Market liquidity utterly collapsed. Assets that couldn't be easily pledged to the Fed or used in the core repo market became almost unsellable at any reasonable price. Their shiftability vanished. Liquidity just disappeared, like that quote says, here today, gone tomorrow.
And borrowing rates spiked in markets the Fed didn't directly backstop.
Dramatically. The eurodollar market, crucial for global banks funding their dollar assets, saw rates soar. The commercial paper market froze. The repo market itself seized up. And a huge part of the problem was the interconnectedness with the shadow banking system.
Ah, the shadow banks. What was their role in this breakdown?
The sources describe them not as separate, but as deeply integrated into this dealer system. Entities like SIVs, structured investment vehicles, conduits, money market funds they were funding long-term, often complex assets like securitized mortgages, MBS, and collateralized debt obligations, CDOs.
Using very short-term funding raised in the money markets like asset-backed commercial paper, ABCP, or repo.
Precisely. Funding long-term illiquid assets with overnight or very short-term borrowing. The critical vulnerability was that, unlike traditional regulated banks, they lacked direct access to the central bank's lender of last resort facilities and didn't have deposit insurance. They were totally reliant on market confidence.
So they were incredibly vulnerable to runs if their short-term lenders got nervous.
The funding could disappear instantly. And that's exactly what happened, driven by increasing anxiety about the value of the underlying collateral those subprime mortgages packed into securities.
Walk us through the timeline from this perspective.
Okay, late 2007. The run starts in the ABCP market. Lenders refuse to roll over paper backed by dodgy collateral. Other funding markets like repo and unsecured financial commercial paper expand briefly to fill the gap, with traditional banks effectively acting as private lenders of last resort to these shadow entities connected to them.
The Fed's first moves were aimed at the traditional banks.
Yes, trying to ease funding pressures there. They relaxed terms of the discount window, created the term auction facility, TAF, to auction funds to banks, and sold off treasury bills from their portfolio, essentially offering the market a safe asset alternative to the toxic paper everyone was trying to dump.
Trying to stabilize the core and absorb the flight to safety.
Right. But March 2008, Bear Stearns collapses. This is when the repo market itself comes under intense stress. Lenders weren't just worried about collateral value, they started demanding massive haircuts lending, much less against the collateral's face value. They were pricing in the risk that they might have to sell the collateral immediately in a fire sale. Shiftability was evaporating even for previously okay assets.
The market's ability to value and trade assets was breaking down.
Exactly. Then, September 2008, Lehman Brothers fails. AIG, a massive insurer crucial to the system, needs a bailout. Now, even unsecured lending between financial institutions freezes. No one trusts anyone else's promise. The only counterparty everyone wants is the government.
A total seizure.
Even the Treasury repo market, usually the safest, most liquid experiences, severe dislocations, because everyone wants to hold the treasuries, not lend them out. And globally, there's a desperate scramble for U.S. dollars, especially by foreign banks who funded dollar assets but lacked direct access to the Fed. This leads to the Fed setting up massive swap lines with other central banks to channel dollars abroad.
So how does this money view interpretation differ from the simpler, more traditional bank run story like in It's a Wonderful Life?
Well, the Jimmy Stewart bank run story is definitely part of it. Depositors and short-term lenders were running, demanding their money back, forcing the Fed to act as lender of last resort on an unprecedented scale, massively expanding its balance sheet. But the money view argues that's incomplete.
What does it add?
It sees 2008 fundamentally as a failure of the dealer system. Market liquidity collapsed, not just because people wanted cash, but because the private dealer system, the investment banks, the integrated shadow banks, became unable or unwilling to perform its crucial function. Making markets, absorbing order flow, and translating funding liquidity, which the Fed was trying to provide, into market liquidity, the ability to actually buy and sell assets.
The intermediaries broke down.
The plumbing failed. And critically, the sources highlight the role of instruments like credit default swaps, CDS.
Insurance against default.
Yeah, but they also became a key source of liquidity and price discovery for complex assets like mortgage-backed securities. Investment banks were huge dealers in the CDS market, quoting prices, often hedging their own exposures by buying protection from insurers like AIG. The ability to buy CDS protection was seen as making the underlying bonds safer and more liquid.
So the CDS market was part of the liquidity plumbing, too.
Absolutely vital. When confidence in AIG's ability to pay out on those swaps collapsed, the perceived safety and liquidity of the underlying bonds vanished. The CDS market seized up, the system worked in reverse, and prices for things like the ABX index, tracking subprime bonds, plummeted. The price crash reflected the breakdown of the market-making machinery as much as fundamentals.
Wow. So the crisis revealed the Fed couldn't just be a lender of last resort.
It had to become, effectively, a public dealer of last resort. When the private dealer system froze, the Fed had to step into markets directly buying assets, providing funding against a much wider range of collateral than ever before, dealing with new types of institutions. Programs like TAF, Term Asset-Backed Securities Loan Facility, were essentially the Fed acting as a dealer to restart securitization markets.
Taking on the market-making role the private sector abandoned.
Exactly. And a key difference from Bagehot, interest rates went to near zero. The Fed could do this because, unlike the Bank of England with gold, it faces no hard constraint on creating dollars. In a global crisis, Fed liabilities reserves become the ultimate safe haven asset. The Fed's role, from this view, is fundamentally about managing and backstopping this entire complex dealer system, not just setting an interest rate.
That's a profoundly different view of central banking than usually presented. How does it contrast with the dominant academic views that influence policy today?
The sources point out a pretty stark contrast. A lot of mainstream academic macroeconomics today relies on models like dynamic stochastic general equilibrium DSGE models.
DSGE, right? Heard of those.
These models are mathematically sophisticated, often built around optimizing agents and rational expectations. But, the critique goes, they tend to abstract away from the very financial plumbing, the dealers, the payment systems, the hierarchy of money and credit that the money view sees as central.
They assume the plumbing just works.
Or that it's not fundamentally important to the big picture outcomes, like inflation and output. Policy advice coming from this framework often centers on inflation targeting.
Set an inflation goal, adjust interest rates to hit it.
Basically, yes. The main policy tool is usually a short-term interest rate, like the Fed funds rate. The central bank commits to a rule, like a Taylor rule, for setting this rate based on inflation and maybe the output gap. The idea is this commitment anchors public expectations about future inflation, and those expectations guide private sector decisions today. Debates often happen within this framework: what's the best rule, how to handle the zero lower bound, etc.
So how does the money view critique this dominant approach?
Several key points come up in the sources. First, the abstraction from money, credit, and the actual financial plumbing is seen as a huge blind spot.
Hmm.
It misses the sources of instability and the real transmission mechanisms.
Ignores the dealers and repo markets.
Right. Second, the focus in DSGE models on explaining deviations from equilibrium using frictions or rigidities is seen as missing the point that credit systems are inherently unstable and cyclical due to the dynamics of confidence and leverage we discussed. Instability isn't a friction, it's fundamental.
It's baked into the elasticity and scarcity dynamic.
Exactly. Third, the implication from simple interest rate rules, like the Taylor rules, building on Wixellian ideas, that central bankers mainly just need to watch inflation and output, not the messy details of money markets, is strongly rejected. The money view insists you have to watch the plumbing, because that's where crises start and where policy actually hits first.
You can't ignore the engine room.
You can't. Fourth, the idea in many theoretical models that liquidity is essentially a free good in normal times creates, as one source puts it, an illusion that masks the system's fragility. Liquidity can vanish instantly. Fifth, there's a critique that the policy bias towards ease, especially without the discipline of a gold standard, has tended to fuel credit bubbles built on dealer-provided liquidity, with central banks sometimes denying responsibility for managing those asset market cycles.
Because their mandate is just inflation or employment, not asset bubbles directly.
That's often the stated view. But the money view argues monetary policy works first through dealers and asset prices, not through the old money multiplier channel affecting bank lending via excess reserves. And finally, the view suggests that managing liquidity and achieving broader economic stabilization are not separate problems. They are deeply intertwined. You can't stabilize the economy if the financial plumbing is broken.
It sounds like the money view is arguing for a fundamental rethink of central banking's focus. Maybe less emphasis just on inflation targets and more explicit attention to the health and stability of the financial architecture itself, particularly this dealer system.
That's certainly a strong implication running through these sources. And this connects to one final interesting concept we found: the idea of reflux.
Reflux, like flowing back.
Exactly. It's an old idea, drawing on the historical law of reflux, debated back in the 19th century. The basic concept is that new money created by banks through lending doesn't just sit out there permanently. It gets spent, circulates, and eventually finds its way back to the banking system.
How does it flow back?
Well, the borrower spends the loan money. The person who receives that money might deposit it in their own bank account. Or, crucially, they might use it to pay off their own loan. When a loan is repaid, the deposit money used for repayment is effectively destroyed, and the loan asset disappears from the bank's books. Money is extinguished.
Ah, so money creation is matched by money destruction when loans are repaid.
That's the reflux idea. It provides a balancing mechanism.
Yeah.
The elasticity of banks creating money when they lend is disciplined by the eventual reflux of that money back to the banking system, often leading to its destruction through loan repayment. Keynes touched on this too, with his idea of a revolving fund of liquid finance. Credit expands, finances activity, and then contracts as projects are completed and loans repaid.
So bank credit allows transactions to happen before savings accumulate, but the system has this self-regulating flow.
That's the argument. Now, the sources dig into the question: if the bank just creates the initial deposit, who is actually funding the loan over its life?
Good question. If the bank didn't lend out pre-existing savings.
Right. The source suggests that initially the person who accepts the newly created deposit as payment, say the person selling the house to the mortgage borrower, is temporarily funding the loan by holding the bank's IOU, the deposit. But who holds the claim ultimately? The sources lay out three possibilities for where that newly created money ends up.
Okay, what are they?
One is pure reflux. The new money circulates and is quickly used to repay outstanding bank debt somewhere in the system. In this case, there's no net increase in total credit. The banking system just replaces one loan with another.
The total amount of money credit stays roughly the same.
Right. The second possibility is capital funding. The new money gets passed along, and eventually, someone outside the initial transaction, maybe investors, the rest of the world in the model, ends up holding the loan asset itself, perhaps packaged up in a security. Think securitization.
So the loan gets sold off, funded by investors buying the asset.
Exactly. The third is money funding. The new money gets passed along, and ultimately someone else, rest of the world, ends up willingly holding the newly created money balances, the deposits, as part of their portfolio. In this case, the demand to hold money has increased to absorb the new supply created by the loan.
So the money either flows back and cancels out, gets replaced by someone holding the loan asset, or gets absorbed as new money holdings.
Those are the limiting cases described. And this flow, this flux and reflux, is linked to interest rates. The sources argue the liquidity theory of interest rates is primarily about the interbank rate the cost banks pay to borrow reserves from each other when deposits created by their loans flow out to other banks. It reflects the cost of funding during this adjustment process.
It's the price of managing the flows between banks.
Yes, and this dynamic view is contrasted with, say, James Tobin's new view from the 1960s. The sources argue Tobin's approach abstracted away from this flux and reflux, treating banks more like simple intermediaries managing deposit inflows and reserve constraints, missing the crucial role of banks directing the economy through their credit creation decisions. Post-Keynesian economists heavily criticize this abstraction.
They wanted to keep the focus on credit creation and its flow. And does this reflux idea apply to government-created money too?
Yes. The sources suggest that state money, fiat money, also follows a pattern of creation through deficit spending and reflux. There's a debate mentioned. Tobin thought excess central bank money would just push up asset prices. But MMT proponents, like Ray cited in one source, argue excess central bank money can exist without causing inflation if channels for reflux are open like taxes or government bond sales that drain that money back out of the system.
So for both private bank money and government money, it's not just about creation, but also about how it flows back or is absorbed.
Understanding that complete circuit, the creation and the reflux, is key from this perspective. It reinforces the idea that money is fundamentally credit, and its journey is crucial.
Wow. Okay, we've covered a lot of ground here. It's really a paradigm shift from the simple stories.
It really is.
We started with the fundamental idea. Banks create deposit money when they lend. It's not just intermediation.
Bank-originated money and debt. Endogenous money.
And governments create fiat money, net financial assets, when they deficit spend without borrowing back from the non-government sector.
A feature, not necessarily a bug, in that framework.
Then we saw the financial system as this hierarchy of money and credit, from securities up to deposits, currency, and ultimately central bank reserves, or maybe gold historically.
With that constant tension between elasticity from below and scarcity from above.
And how the moneyness of different layers changes, especially in crises. We debunked the simple money multiplier model.
Arguing loans create deposits, create reserves, not the other way around.
And explored the money view's focus on the actual plumbing, Bagehot's principles, and the critical role of dealers linking funding liquidity in money markets with market liquidity or shiftability in capital markets.
With repo being the absolute linchpin of that modern dealer system.
And the 2008 crisis, a catastrophic failure of that dealer system, forcing the Fed to become not just lender of last resort, but dealer of last resort.
A role fundamentally different from Bagehot's, enabled by the fiat dollar system.
We contrasted this with mainstream models that often ignore the plumbing, and finished with reflux, how created money flows back, gets extinguished, or finds a home, balancing the system.
It paints a picture of finance that's far more dynamic, complex, and frankly inherently fragile than the textbook equilibrium models often suggest. Understanding this plumbing, the credit creation, the hierarchy, the dealers, the reflux, feels essential to grasping why the system behaves the way it does, especially when it breaks.
Absolutely. And knowing this helps make sense of so much, doesn't it? Interest rate moves, credit crunches, asset bubbles, financial crises. It gives you, the listener, a much deeper framework for understanding the financial news and how it impacts your world, your savings, your investments.
It lets you ask better questions, look beyond the surface explanations.
So, building on everything we've unpacked from these sources, here's a final thought to leave you with. Given that our modern financial system seems to be fundamentally a dealer-based system where liquidity relies on their market making and the biggest crises involve their failure, forcing the central bank to step in as the ultimate dealer, Should the main job description of central banking change?
Hmm.
Should the primary goal shift, perhaps, from just targeting inflation or employment levels towards more explicitly managing and ensuring the liquidity and stability of this entire complex dealer system itself, including its shadow banking elements? And what would that imply for how we regulate finance in the 21st century?
That is the multi-trillion-dollar question, isn't it? If the plumbing is where the problems often start and where policy has its first impact, maybe the plumbers need to focus more on the pipes themselves. Definitely something to chew on next time you hear about the Fed's latest move.